Hello friends. Last week in my video, I basically said the bulls were appearing a little tired and maybe they need to pick up their proactive buying support to kind of push markets higher. And sure enough, you saw fatigue at higher levels. Of course, expiry of the September derivative series also played a part. And you would have seen WhatsApp forwards coming in from multiple sources. At least I have received from many groups that I'm a part of, where they're saying that October typically, historically, has been a positive month for both the Nifty and the Bank Nifty. Can this hold true? Will October 2023 be bullish for the markets? In this video, I'm going to discuss that. But before we go forward, do remember that just like not all 5 fingers on your palm are of the same length, every October need not conform to historical precedents here. So in all 10 years going back in time, you will see that gains or losses in October need not be uniform. Keep an open mind. Let the market statistics tell us where they are going. And that's precisely what we are doing now. We dive right in and on your screen right now. And what the market roundup window tells me is that the broader base Nifty 50 fell more than the Bank Nifty, and the US dollar index continued to climb and has gained 59 basis points, the Dixie that is. And that basically had a similar rub off on the USD INR, that means the US dollar versus the Indian rupee, which gained 21 basis points. And because the dollar is the invoicing currency in the global commodities markets, you basically saw gold and silver prices come down, silver more than gold due to the higher volatility. Oil went up due to the drawdown or decline in petroleum reserves of the US. And natural gas appears, I'm using the word appears, to have gone up because this is nothing but cost of carry that is extremely high from 1st of October onwards every year till typically December or Jan. Do remember, this is the winter, official winter season, and natural gas is used as a heating fuel in the Western world. So typically till December, Jan, you will see 20, 25, 30 rupees cost of carry per month. It will appear on the charts as if natural gas is rallying, but this is COC, cost of carry. The Dixie went up, the USD INR went up, Indian 10-year benchmark bond yields went up 6 basis points. That is ahead of the RBI's Monetary Policy Committee meeting on the 6th of October, which is a Friday. So bond prices are telling you that they do not expect an immediate decline in coupon rates. Even though the headline indices were down, the NSE market capitalization was up a little under 0.5% on a week-on-week basis, which means that the index heavyweights saw some declines, but the broader markets were still relatively better off. Where the US indices are concerned, barring the NASDAQ, the Dow Jones Industrial Average and the S&P 500 fell. So they provided headwinds for domestic markets. Friends, I now come to our in-house studies and indicators. I start with MWPL or market-wide position limits. Now, these are exposure levels utilized by traders as a total percentage allowed by the Securities and Exchange Board of India, SEBI. What you saw is the peak of MWPL reached in the September derivative series was 38.43, as you can see on your screen. In August, it was 39.20, which means that the high made in September was lower than the high made in August. Now, let's take a look post-expiry after the September series. Now, we are at 28.35. It's just a tad higher than 28.27. That basically tells you that the formation of higher tops and higher bottoms in the MWPL seems to be struggling. I'm not saying it has ended. It's early days yet to pass a decision like that, but it seems to be faltering. What does it tell you? That conviction in the buy and hold trading community seems to be a little shaky. But then let's give it a benefit of the doubt, and you have expiry, which you can attribute this to going forward. Let's see how this goes. The stock and index turnover. This is again a weekly chart, and I've taken three concurrent derivative cycles, that is October, November, and December. Do note every 4 weeks the turnover spikes. Why is this? Because of expiry. Traders close their position in the expiring month and initiate similar positions in the next month. That results in dual turnover. So every 4 weeks you'll see a spike. But having said that, stock futures turnover is almost at the highest point in the 20-week chart period. And the index futures turnover is also at its upper end that we have seen. So one Marshmallow trader participation was fairly good. Now I come to the NSE advanced decline ratio. This is a weekly chart again. This is an average of all trading sessions during the week. What we saw was that the Nifty, which is indicated as a red line here, lost less compared to the prior week on a weekly basis. But the advanced decline ratio actually rose smartly to 1.12, which means for every 100 losers, there were 112 gainers. Remember, this is a weekly average, as compared to the prior week's 0.70. So that tells me that intraday traders were showing a lot more confidence as compared to the buy and hold traders. What does it mean? That one Marshmallow traders were bullish, but two Marshmallow traders were cautious. Don't worry about the Marshmallow theory. The video is given in the description below this video and in the pinned comment below this video as well. I now come to the prompt a month futures basis. What is the basis? Basis is a premium or discount in the futures compared to spot. What does it tell you? It tells you the risk appetite prevalent in the markets. The higher the basis, higher is the premium that traders are willing to pay to buy time. And right now they have 4 full weeks before the expiry in October. So they are willing to pay 263 rupees on the Bank Nifty and 70 rupees, almost 71 rupees on the Nifty 50. This is an element of time. Just like options premium, basis also compresses with time and risk appetite. Will 263 rupee basis on the Bank Nifty last? I don't think so. Neither will 71 rupees in the Nifty 50 itself. I wouldn't be surprised if the basis falls in the coming week and falls noticeably. So let's keep an eye on that. I update this chart every day on my social media accounts. Do make the effort of connecting with me there. I now come to our in-house exclusive indicator, the impetus, which measures the force or velocity of any particular move. Last week, I said that the impetus readings were down, which meant that the declines in both the indices were on a very shallow selling pressure, right? And that basically tells you that the bears were not really very forceful about their selling pressure. But look at what's happened in this week's chart. The impetus readings for both the indices are up, and unfortunately the indices are marginally down, which tells me that the selling was forceful. Part of this could be due to the expiry of September derivative series. We need to see what happens now going forward in the week ahead. If the prices and impetus readings rise, bulls are still back in control. But if the prices are falling with rising impetus, that could spell trouble. Friends, I now come to another exclusive in-house indicator that you've trusted for almost 2 years now, the Lift Weight Thrust Drag Index, or the LWTD index. Note how in last week's video, I told you that the Nifty had plunged below 0.5% on a week-on-week basis, but the LWTD has spiked, which meant that I expected support coming in at lower levels. And sure enough, the markets lived up to these expectations, and the indices kind of narrowed their declines. But unfortunately, the LWTD has come down from 0.31 in the prior week to 0.22 in the week gone by. What does it mean? It means at higher levels, fresh buying may be just slightly muted. Can this change? Yes, it can, which is why the LWTD chart, which is weekly here, I update on my social media accounts on a daily compression basis late in the night. Do connect with me there. There you will be able to update yourself in real time. Friends, our in-house indicators done. I now come to the bond markets, which are likely to remain in the news because the 6th of October marks the RBI Monetary Policy Committee meeting and interest rate decisions are likely. The major segment of the market expects a status quo or no change. At least I don't expect the rates to come down. Now, what you are seeing on the weekly chart of the Indian 10-year benchmark bond yields is that bond yields have gone up, and the blue color horizontal trend line is proving to be a rough and ready support level for approximately 2 months now. As long as this holds, it's a little over 7.12%. As long as this holds, the Indian bond yields are holding steady. What am I doing? I'm not laddering any sovereign investments right now because it makes sense only to do that laddering part above 7.5, 7.6, or go into gilt funds below 7.05 or maybe 7.0%. So I'm holding on to my checks. Friends, the bond market's done. I now come to the Bank Nifty, which lost 0.06%, thereby losing less than the Nifty 50. The daily chart on your screen shows declines on 2 out of 5 trading sessions, but Thursday's decline was noticeable and large enough to result in a week-on-week loss on this index. The price is back to its head and shoulder neckline, which I've marked as a red color dashed line. We are precariously poised at the neckline and the price is below its month-long moving average. So short-term traders who bought the Bank Nifty are likely to be suffering a short-term pain of mark-to-market losses. Bulls will be back in the saddle only above the 45,250 levels. That is a large power candle which was bearish, and once you've absorbed all that selling of the past and gone above that level, I think the sellers will back off and stop offering that kind of resistance. Now, going to the weekly chart, what you are basically seeing is that the Bank Nifty is rising in a wedge formation and the peaks are getting narrower. The best days that this index logged, where bulls are concerned, were between June to November 2022. Thereafter, the rally has been present, but it's been, relatively speaking, a little slower. The price is above its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium-term outlook is positive for now, but it's very close to that price, and also the trend line, the blue color trend line below that at slightly over 43,000 will also provide support in the near term. But between the two, I feel the Bank Nifty and the Nifty, between the two, I feel Bank Nifty is, relatively speaking, slightly more under pressure from the sellers. In the week before last, this index was number 3 on the volatility rankings based on statistical beta that we maintain in-house. It maintained that level at number 3, and the challenge level for retail traders remains unchanged. Last week, I advocated an expected range between 45,750 on the upside and 43,475 on the downside, which held perfectly well. In the coming week, I anticipate an expected range between 45,700 on the upside and 43,475 on the downside. Not much of a change, but do remember, on a week-on-week basis, the Bank Nifty has hardly moved at all. Friends, the Bank Nifty done. I now come to the Nifty 50, which lost a little more than the Bank Nifty in percentage terms last week. And the daily chart on your screen basically shows that in action. The price is below its month-long moving average, which means short-term bulls are under pressure from mark-to-market payments. And just like the Bank Nifty before it, the negative candle, the bearish candle on Thursday, is a fairly pronounced power candle, which means we need to go above Thursday's candle's high before we can say that bulls are even showing signs of coming back into the saddle. Friends, let's take a look at the weekly chart on your screen of the Nifty 50. A couple of points here. First of all, let's look at the harmonic AB is equal to CD formation. That would have basically reached fruition or target being met at between 20,500 to 20,600, give or take. And we've almost, I'm not saying exactly, but almost reached there. So we would have seen exhaustion there from the AB is equal to CD formation. Secondly, there is a flag formation which I have marked towards the end. We broke out of the flag formation 4 weeks ago, but are now looking like the markets are under pressure. I've drawn a horizontal trend line, a blue color horizontal trend line, which is at 19,224 level. If the price falls and sustains below this level, the bulls would be severely under pressure, and therefore October may not be as kind to the bulls as those WhatsApp forwards are basically making out to be. So the reason why I'm not making prophecies or predictions is because I am a captive or a slave to data, and unless the market tells me which way it is going, I would rather reserve my comments. So I would watch 19,224 on the spot segment in cash on the Nifty 50 before saying that bulls have completely been washed out. The price is above its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium-term outlook is positive also. Do note how the price is relatively between the two Bank Nifty and Nifty index. The price is significantly higher than the 25-week exponential moving average in the case of Nifty 50. So the chart is a whole lot more stronger here. Now, friends, in the week before last, this index was number 7 on our volatility rankings based on statistical beta that we maintain in-house. It fell 2 notches to number 9. Do remember, it was a week with very narrow trading ranges. So the challenge level seems to have come down a little. Also, I have been telling you both in my video and in my live mint column that very high MWPL results in higher volatility, because higher positions means bigger amount of unwinding taking place whenever one side surrenders their positions. And MWPL have come down routinely, of course, after expiry. Last week, I advocated an expected range between 20,000 and 50 on the upside and 19,275 on the downside, which held perfectly well. In the coming week, I expect an anticipated range between 20,000 on the upside and 19,275 on the downside. Do remember, it's very, very close to the 19,224 level, which I showed you on the weekly charts horizontal trend line. The week is short because of holiday and therefore 4 trading sessions. Invariably, that could raise the possibility of higher volatility. So let's be careful out there. Friends, I now come to the last bit of statistical analysis by way of retail risk appetite. And this is another reason why I say that October should be watched, not taken for granted as a month favoring the bulls. Now let's take a look at the daily chart of, the weekly chart of the contribution by various segments of the market. Index futures, shown as a blue line, contributed 1 basis point higher in turnover, and stock futures contributed 20 basis points higher. It is shown as a red line. Are you surprised yet? I don't think you should, because this was expiry. Like I told you, traders close their positions in the expiring month and reinitiate them in the next month. So the turnover is logged as double. Now, between the options, the lowest risk option is the index option. There, the turnover went up. It is shown as an army green line, and the turnover seems to have gone up there. And the stock options turnover, shown as a purple line, has come down sharply. Between index options and stock options, index options are less volatile and take lesser amount of margins if you want to write these options, or they require, relatively speaking, lower amount of premium if you want to buy these options compared to stock options. That tells me that retail risk appetite was compressed. Now, I'm granting, or I'm willing to grant, a benefit of the doubt, because traders knew last week Monday was a holiday, so why take bigger chances when you can come back on Tuesday and reinitiate bigger positions? And B, there was expiry, a much bigger trigger. So let's watch the price discovery mechanism that will kick in from the coming week itself and then take it forward from there. Friends, I now come to my trading blueprint for the week ahead, and I'm kind of preoccupied, or total top of the mind recall is dedicated to the RBI announcement on 6th of October. It's not just about the ultimate decision of interest rates, but the RBI governor's commentary and observations on the policy and economy are equally important and enlightening. Do spend that half an hour, 45 minutes, whatever time he takes to announce, as time very well spent about understanding the market. Obviously, because it's the RBI announcement week, banking and interest rate sensitive stocks will be in the limelight, and they will make larger than average moves, which actually helps traders because we want higher volatilities. And trades in any direction are okay as long as the move is big enough. Now, with the US dollar appearing strong, bullion is under pressure. And do remember, I've told you many a times before the US elections. For example, now in November 2024, you have presidential elections. The dollar is strengthened and bullion is subdued, so as to push up higher risk assets like bonds and typically equities, of course. So it's not really very surprising that bullion is a little subdued, because ultimately a strong dollar means weaker commodities. Now, where energy prices are concerned, I think oil and gas should see a slower rate of climb or rallies. I'm not saying that it will continue to zoom. It may continue to rise, because that's what the Saudis and the Russians want. But at higher levels, with WTI, whenever it crosses 92, 93, approaches 95, you are seeing a supply coming in. So, and natural gas, like I mentioned earlier, it's not a price rise, even though your chart might be saying that there's a power candle. It's actually cost of carry, the difference between one derivative month to the other. This will continue till December or Jan. Deep-pocketed traders with extremely high risk appetite should prefer a strategy to capitalize on a theta decay in the options segment. But if at all you are initiating theta decay trades, I would suggest you do what Mexico's Pemex does with the famous Hacienda hedge. That's a tail risk hedge. It makes more sense. And clarity where equity markets are concerned will come after the RBI announcement on Friday. It should come latest by 10:30, 11 a.m. That still gives you a lot of time to trade on Friday. Friends, before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And in the comments segment, do let me know how my videos are helping you decipher the moods of the market better, based purely with a data analytical approach. Also, help me reach out to fellow like-minded smart traders like yourselves by sharing my video with your family and friends. I thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very, very profitable week ahead. Take care. Bye-bye.